Good morning, options traders, and welcome back, everyone. I hope everyone had a great weekend. And I just received an interesting text message via Facebook here from one of the traders in this group. And he said, what happens if nobody buys my option? And I thought this would be a good topic to talk about because I've heard this before from traders, and they have this unrealistic fear that what happens if we get to expiration, the stock's been running, but there's just no volume, that nobody's there to buy my option. Am I going to lose my money? So here's a detailed look at the question and the fear. So let's say the stock is trading for 100 and you buy the $100 call for $2. Stock continues to run. In fact, it rises to 110 at expiration. So you're thinking, well, this call option should be trading for $10, right? We all know that options have to reflect all intrinsic value. And at expiration, there's no time remaining, so there's no time value. So this option should be trading for 10. But what if there's nobody there to buy? Are you going to get stuck? Are you just going to have to say, well, I can't sell it, so I lost that potential profit? Well, the answer is no. And there's a couple of reasons to figure out why that's true. But first of all, let's just assume that there was nobody there to buy. No volume, no bidders. What could you do? Well, you can always do what's called exercise and cover. And what you would do here is you would short the stock, which is, remember, currently trading for 110. So you'd collect $110 cash. Now, of course, when you do that, your stock position in your broker's platform is going to show minus 100 shares. That means there's 100 shares that you owe. Well, that's not a problem. What do? Just turn right around and exercise the $100 call, which means you have to spend the strike or $100 cash. Where do you get the $100 cash from? Right here. Remember, you shorted shares at 110. So it's self-financing. You don't even need the cash in the account. Short the stock, turn right around and exercise the call. When you exercise the call, you will be long 100 shares, and those are going to cancel. So when it's all over and done, you've collected $110 cash, spent 100, and you're left with $10 cash, exactly what you should have received from selling the call. So it's exactly these series of steps here, or this idea, that ensures that your option is never going to even fall below intrinsic value, or that there will always be somebody there to buy. And the process is actually called arbitrage. And I've talked about this in a number of different videos, but it's a really interesting topic in finance. And what arbitrage is, it's a series of trades that result in a guaranteed profit. But it's actually a little bit more than that. It's a guaranteed profit with no money required out of pocket. See, if that second condition wasn't put on there, you could go out and buy a T-bill and say, hey, I got a guaranteed profit, and therefore it was an arbitrage. No, it's not, and that's because you had to spend money to buy that treasury bill. This is even better. So let's go back and revisit the situation where the stock is at 110, but let's say we're not at expiration. Maybe we've got 30 days to go. And the concern is, well, what happens if my $100 call is, let's say, trading for 8? There's just not enough volume or enough buyers in here to push it up to that $10 minimum. Again, it's an unwarranted fear. Because what the arbitrageurs would do, which is pretty much all done by computers these days, and trust me, there are lots of computer bots that are out there every second of the day scouring the markets looking for these pricing discrepancies. And if they were to see this with the stock at 110 with a $100 call trading at 8, it's going to do exactly the same thing. It's going to short that stock for 110, get $110 cash. It will then buy the call for 8. It's going to spend 8. And so far it has a net $102 cash. What does it do then? Because remember, it's got a short stock position. It's going to exercise and spend 100. Where does it get the $100 from? Hopefully, remember, from right here, from the $102 cash. It's self-financing. That's what makes it an arbitrage. And so when it's all over and done, it has a $2 profit guaranteed for no work, for no money out of pocket. So why is this important? Well, as this continues and they continue to short this stock, it's going to put downward pressure on this stock. Remember, this is free money. People aren't just going to say, well, let me just do it once or twice. They are going to hammer this stock hard. And to complete the arbitrage, they will have to buy the call. And of course, that's going to put buying pressure on that call. And so what has to happen really in a matter of seconds is that that call will have to trade for at least intrinsic value. So once you understand the process of arbitrage, the entire fear becomes unwarranted. And there's a similar process that would happen for puts as well. So this is important for traders to understand, because if you don't realize that arbitrage will always keep all options trading for at least intrinsic value, you might get shaken out of trades out of false fears. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find the link in the description below.